Most people will spend 40 years working. They will earn somewhere between $1 and $3 million over their lifetime. And by the time they retire, the majority of them will have almost none of it left. Not because they were lazy, not because they were stupid, but because they were never taught how money actually works. And that gap between what schools teach and what money actually does in the real world, that gap has quietly made a small number of people extraordinarily wealthy, while everyone else stays exactly where they started. This is not a video about getting rich. This is a video about understanding the system you're already inside. Because whether you like it or not, you are playing a financial game every single day. The only question is whether you know the rules. Let us start with the one concept that almost no one truly understands, even though it is the single most powerful force in personal finance: compound interest. You have heard the word. You probably nodded along in school. But here's what compound interest actually means in practice. If you invest $1,000 today at a 7% annual return, in 10 years you have roughly $2,000. That feels fine. Double your money, not bad. But leave it for 30 years and that $1,000 becomes nearly $8,000 without you doing anything. No extra work, no extra deposits, just time. Now here's where it gets strange. Most of the growth in that 30-year period happens in the last 10 years. The first 20 years build the foundation. The final decade is where the machine runs at full speed. This is why starting at 25 and starting at 35 are not the same decision. They are completely different financial lives. A person who invests from 25 to 35 and then stops will likely retire with more money than someone who invests every single year from 35 to 65. Let that sit for a second. 10 years of early action can outperform 30 years of late action. That is not a motivational poster. That is mathematics.
Now let us talk about inflation. Because compound interest is only half the story. Inflation is the quiet force moving in the opposite direction. It does not announce itself. It does not send you a bill. It just slowly, steadily erodes the purchasing power of every dollar you hold. Here's a number worth knowing. The average inflation rate in most developed economies sits somewhere around 2 to 3% per year. That sounds harmless. It is not. At 3% inflation, the purchasing power of your money is cut in half in roughly 24 years. So if you have $100,000 sitting in a savings account earning 0.5% in interest, you are not being safe. You are losing money in slow motion. This is the mechanism that most financial education never explains clearly. Keeping cash feels safe. But cash over time is a depreciating asset. The system is not neutral. It has a direction. And if your money is not growing at least as fast as inflation, you are falling behind while standing still. So what are the options? This is where the concept of asset classes comes in. And this is where things get interesting. An asset class is simply a category of investment. Cash, bonds, stocks, real estate. Each one behaves differently. Each one carries different risks and different return potential. Historically, equities, which is just a formal word for stocks, have returned an average of around 7% per year after inflation over the long term. That is not guaranteed. Markets go up, markets go down. Some years are catastrophic, but the long-run average is remarkably consistent when you zoom out far enough. Bonds are more stable, but grow more slowly. They are essentially loans you give to governments or companies in exchange for regular interest payments. Lower risk, lower reward. Real estate sits somewhere in between. It is tangible, which makes people feel comfortable with it, but it is also illiquid, which means you cannot sell a bedroom when you need cash next Tuesday. Here's what most people miss. You do not have to choose one. And in fact, spreading your money across different asset classes is one of the oldest and most validated strategies in investing. It's called diversification. And the reason it works is simple. When one category falls, another often rises. You are not betting on a single outcome. You are building a portfolio that can survive multiple outcomes. Now, here's the uncomfortable part of this conversation. Understanding these concepts does not automatically make you money, because the human brain is spectacularly bad at making financial decisions. There is a well-documented phenomenon called loss aversion. Studies consistently show that people feel the pain of losing $100 roughly twice as intensely as the pleasure of gaining $100, which means when markets drop, the emotional impulse is to sell, to stop the bleeding, to get out. And that is almost always the wrong move. The investors who consistently outperform the market over decades are not smarter than everyone else. They are just more boring. They buy regularly, they do not panic sell, and they let time do the heavy lifting. Warren Buffett has a quote on this that has been cited so many times it has almost lost its meaning, but it is worth restoring. He said that the stock market is a device for transferring money from the impatient to the patient. That is not wisdom. That is a description of a mechanism, and the mechanism is real. So where does that leave you? You are living inside an economic system that rewards people who understand compound growth, who protect their purchasing power from inflation, who spread risk intelligently across asset classes, and who resist the emotional impulses that lead most people to buy high and sell low. None of this requires a finance degree. None of it requires a broker or a wealth manager or a secret strategy. What it requires is a clear understanding of how the system works, and then the patience to let it work. The uncomfortable reality is that financial literacy is not a school subject in most countries. It is not taught systematically, and the result is a population that earns money every day but does not understand what money actually is, what it does when it moves, or how to make it work for them instead of against them. That is not an accident of history. It is a feature of a system that benefits those who understand it at the expense of those who do not. So, here is the question worth sitting with. If the rules of this game have always been available, always been knowable, always been learnable, why did nobody hand them to you sooner? And more importantly, now that you have them, what exactly are you going to do with them?